So you're sitting on a $50,000 crypto portfolio, seeing great gains, but feel trapped by potential taxes if you sell. Selling means a massive chunk goes to the taxman, and you lose all that future upside. But what if you could access cash flow without selling your assets, just like the truly wealthy? This video reveals a simple strategy to turn your crypto into a cash-generating machine, funding your life while your investment grows. Discover how to optimize your tax liabilities and leverage your digital assets for both cash flow and continued growth. Let's be honest, most of us got into crypto to change our financial reality. We saw an opportunity and had the guts to take a risk that most people wouldn't. And for a lot of you watching, that risk paid off. You've watched your portfolio double, triple, maybe even 10 times. That $50,000 on your screen, that's conviction, that's patience. But here's the paradox. Nobody talks about when they're shilling the next moonshot coin. You're simultaneously wealthy and broke. You're asset rich but cash poor. That $50,000 might as well be on Mars, because the second you try to bring it back to Earth, to buy a car, put a down payment on a house, or even just pay off some debt, a huge piece of it just vanishes. This is the brutal reality of capital gains tax, and it is the single biggest dream killer for crypto investors. The IRS treats your crypto as property. That means when you dispose of it, and disposing means selling for cash, trading for another crypto, or even buying a coffee with it, you trigger a taxable event. Let's make this real. Imagine your $50,000 portfolio started as a $10,000 investment you made 8 months ago. You have a $40,000 profit. Because you held it for less than a year, that profit gets hit with short-term capital gains tax. This isn't some special low rate. It's taxed as ordinary income at your marginal tax rate. For 2025, those tax brackets range all the way from 10% to 37%. So depending on your total income, you could easily be looking at a 22% or 24% tax rate, or even higher. Let's just call it 24%. A quick calculation shows that 24% of your $40,000 profit is $9,600, almost 10 grand, gone, poof, instantly. You thought you were cashing out $50,000 to change your life, but you're actually getting $40,400. The taxman got his cut before you even had a chance to smell the money. Now, you might be thinking, okay, I'll just hold for over a year. And yeah, that is a smarter move. If you hold for more than 12 months, you get the much friendlier long-term capital gains rates of 0%, 15%, or 20%, depending on your income. To get that 0% rate in 2025, your taxable income needs to be under about $48,000 for single filers, or $96,000 if you're married and filing jointly. For most people, it's the 15% rate. So on that same $40,000 profit, your tax bill drops to $6,000. That's better, but it's still $6,000 that evaporated just because you wanted to use the value you built. But the financial sting isn't even the worst part. The worst part is the psychological gut punch, the opportunity cost. Every single person who's been in crypto for more than one cycle has a story of the coin they sold too early. You sell your Bitcoin at $20,000 to lock in a profit, pay the tax, and feel smart for a minute, only to watch it scream to $60,000 6 months later. You sold your Ethereum at $1,500 and it runs to $4,000. The feeling is nauseating. You were right about the asset, but you were wrong about the timing. By selling, you didn't just pay a tax penalty, you forfeited all future gains. You permanently exited one of the best performing assets of the last decade. This creates a terrible incentive. It makes you terrified to take profits, forcing you to ride the insane waves up and down, never truly enjoying your wealth. You're paralyzed, locked in a state of what if. These are the golden handcuffs of crypto. So what's the alternative? If selling is a trap, how do you ever actually use your wealth? This is where you need to stop thinking like a retail investor and start thinking like the ultra wealthy. This isn't some secret they hide, it's just a strategy that wasn't really available to the rest of us until now. The people who build and keep generational wealth almost never sell their best, appreciating assets. Think about a founder who owns billions in company stock. When they want to buy a yacht, do they sell a massive block of shares, trigger a huge tax bill, and scare the market? Of course not. Think about a real estate mogul with a portfolio of skyscrapers. When they need cash for a new project, do they sell one of their prized buildings? Nope. They borrow. They walk into a bank and say, I have this asset worth X. It's high quality. I'd like a loan against its value. This is the core principle of how the rich stay rich and get richer. They use their assets as collateral to get cash. That loan, it's not income, so it's not a taxable event. They get the cash they need, tax-free, while their original asset keeps appreciating. They keep their ownership, they keep their upside, and they get the cash. For decades, this was a game for people with stocks and real estate, but the world is changing. Crypto, especially established players like Bitcoin and Ethereum, is now seen as legitimate collateral. The exact same strategy is now on the table for you. The tool is called an over-collateralized loan. A loan is just money you promise to pay back. Collateral is what you pledge to guarantee you'll pay it. Over-collateralized just means you have to put up collateral that's worth more than the loan. Why? Because crypto is volatile. A bank knows your house probably won't drop 50% in value overnight. A crypto lender doesn't have that same certainty. So, to protect themselves, they require a safety cushion. To get a $25,000 loan, you might need to pledge $50,000 worth of Bitcoin. If the price of Bitcoin wobbles, there's a buffer before your collateral is worth less than your loan. This is the aha moment. This is the big shift. You don't have to sell your $50,000 in crypto and pay thousands in taxes. Instead, you can use it as collateral. Borrow against it, say $15,000 or $25,000, and that transaction is completely tax-free. You get real dollars or stable coins in your account that you can spend immediately. Meanwhile, your original $50,000 of crypto is still yours. It's still in the game, ready to catch the next bull run. You've successfully separated your need for cash from your investment position. You've just turned a static asset into a dynamic cash machine. So, what's the alternative? If selling is a trap, how do you ever actually use your wealth? This is where you need to stop thinking like a retail investor and start thinking like the ultra wealthy. This isn't some secret they hide, it's just a strategy that wasn't really available to the rest of us until now. The people who build and keep generational wealth almost never sell their best, appreciating assets. Think about a founder who owns billions in company stock. When they want to buy a yacht, do they sell a massive block of shares, trigger a huge tax bill, and scare the market into thinking they're losing faith? Of course not. Think about a real estate mogul with a portfolio of skyscrapers. When they need cash for a new project, do they sell one of their prized buildings? Nope. They borrow. They walk into a bank and say, I have this asset worth X. It's high quality. I'd like a loan against its value. This is the core principle of how the rich stay rich and get richer. They use their assets as collateral to get cash. That loan, it's not income, so it's not a taxable event. They get the cash they need tax-free while their original asset, the stock, the real estate, keeps appreciating. They keep their ownership, they keep their upside, and they get the cash. For decades, this was a game for people with stocks and real estate, but the world is changing. Crypto, especially established players like Bitcoin and Ethereum, is now seen as legitimate collateral. The exact same strategy is now on the table for you. The tool is called an over-collateralized loan. A loan is just money you promise to pay back. Collateral is what you pledge to guarantee you'll pay it. Over-collateralized just means you have to put up collateral that's worth more than the loan. Why? Because crypto is volatile. A bank knows your house probably won't drop 50% in value overnight. A crypto lender doesn't have that same certainty. So, to protect themselves, they require a safety cushion. To get a $25,000 loan, you might need to pledge $50,000 worth of Bitcoin. If the price of Bitcoin wobbles, there's a buffer before your collateral is worth less than your loan. This is the aha moment. This is the big shift. You don't have to sell your $50,000 in crypto and pay thousands in taxes. Instead, you can use it as collateral. Borrow against it, say $15,000 or $25,000, and that transaction is completely tax-free. You get real dollars or stable coins in your account that you can spend immediately. Meanwhile, your original $50,000 of crypto is still yours. It's still in the game, ready to catch the next bull run. You've successfully separated your need for cash from your investment position. You've just turned a static asset into a dynamic cash machine. Okay, you did it. You've built your $50,000 portfolio. It's ready to be put to work. Now we get to the nuts and bolts, the engineering of your cash machine. To run this thing safely, you need to become an expert on 3 key ideas: loan to value, interest rates, and the one we all fear, liquidation. First, let's talk loan to value, or LTV. The LTV ratio is the beating heart of your loan. It's the most important number you'll be watching. The formula is simple: your loan amount divided by your collateral's value. So, if you have a $50,000 portfolio and you take out a $25,000 loan, your LTV is $25,000 divided by $50,000, which is 50%. If you were more conservative and only borrowed $12,500, your LTV would be 25%. Every lending platform has a max LTV they'll let you start with, often around 50%. But just because you can borrow at 50% doesn't mean you should. This is where risk management is everything. A higher LTV gets you more cash today, which is tempting. A 50% LTV on your $50,000 portfolio gets you a cool $25,000. A 25% LTV only gets you $12,500. The trade-off is risk. A higher LTV leaves you with a tiny safety cushion. A lower LTV gives you a massive buffer to withstand price drops. My personal advice, especially when you're starting out, is to be extremely conservative. Think in the 25% to 30% LTV range. For a $50,000 portfolio, that means borrowing between $12,500 and $15,000. It might feel small, but it builds in a huge margin of safety. You can always borrow more later once you get comfortable. Second, interest rates. Nothing in life is totally free. When you borrow, you pay interest. The good news is that because these loans are backed by solid collateral, the rates are often way better than unsecured debt like credit cards, which can charge a ridiculous 20% or more. Crypto loan rates can be anywhere from under 3% to over 15%, depending on the platform and market conditions. These rates can be fixed or variable. A fixed rate is predictable. A variable rate can fluctuate with supply and demand. You'll usually be borrowing stable coins, crypto pegged to a dollar, like USDC, which you can then easily convert to cash in your bank account. And here's a pro tip and a key tax consideration. If you use the loan money for investment purposes, say you borrow to invest in a business or real estate, the interest you pay on that loan may be tax deductible under specific IRS rules. This is an advanced move right out of the wealthy's playbook. But let's be crystal clear. If you borrow the money for personal stuff like a vacation or a car, that interest is not deductible. Finally, we have to face the danger zone, margin calls and liquidation. This is the most important part of the video. Getting this wrong is how you lose everything. Remember how your LTV is dynamic? It moves with the market. Let's use our risky example. You borrowed $25,000 against $50,000 in crypto. Your LTV is 50%. Now, the market has a bad week. Your collateral drops to $40,000. Your loan is still $25,000. Your new LTV is now $25,000 divided by $40,000, which is 62.5%. Your risk level just went up, and you didn't do a thing. Lending platforms have two tripwires. The first is the margin call LTV, maybe around 70 to 80%. If you hit this, you'll get an alert. It's a warning shot. Hey, your collateral is getting dangerously low. You need to either pay back some of the loan or add more collateral. If you ignore that warning, or if the market dumps so fast you blow right past it, you hit the final threshold. The liquidation LTV may be set at 85% or 90%. When your LTV hits this point, the system automatically sells off your collateral to pay back the loan. This is a forced sale at the worst possible time, when prices are at their lowest. Not only is it a taxable event, but you also permanently lose your precious assets. Your cash machine is broken, and you're left with the scraps. This is the nightmare scenario we avoid at all costs by keeping our LTV low. Okay, time for the practical part. You have two main roads you can go down: centralized finance and decentralized finance. The right choice depends on what you value most: convenience, security, or control. First up, centralized finance. Think of CeFi platforms like Nexo, LeDN, or the loan desks at big exchanges like Coinbase. These are companies that act like crypto banks. You give them your crypto, and they give you a loan. The pros are obvious, especially for beginners. It's easy. The apps are usually slick and feel just like a modern banking app. The process is dead simple. Deposit crypto, click borrow, and you're done. Customer support. If something goes wrong, there's a human you can call or email. That can be a huge comfort. Insurance. Reputable CeFi platforms often use qualified custodians and have insurance on the assets they hold, but the cons are baked into the name: centralization. Not your keys, not your crypto. This is the golden rule. When you send your crypto to a CeFi platform, you're giving up custody. You're trusting them completely. Counterparty risk. This is the big one. What if the company goes bankrupt? The crypto world is a graveyard of failed lenders like Celsius and BlockFi, where users lost billions. When you use CeFi, you're betting that the company is well run and won't go under. Permissioned. You have to do KYC and give them your personal info. They can also freeze your account or deny you service. Next, we have decentralized finance. DeFi cuts out the middleman. Instead of a company, you're interacting with code, smart contracts that live on a blockchain like Ethereum. The most famous and battle-tested lending protocols are Aave and Compound. The pros of DeFi are the direct solution to CFI's problems. You're in control. You always hold your own assets in your own wallet, like MetaMask. You never give up custody. You hold the keys. Total transparency. Everything is public on the blockchain. You can see exactly how much collateral is in the system and how healthy it is. No hidden risks. Permissionless. Anyone with a crypto wallet can use it. No KYC. No one to ask for permission. The cons are the flip side of that freedom. It's more complex. The learning curve is steeper. You need to know how to use a non-custodial wallet, understand gas fees, and navigate interfaces that can be a bit clunky. Smart contract risk. You're trusting the code. While protocols like Aave are heavily audited, there's always a tiny risk of a bug or a hack. You are your own bank. If you mess up, send funds to the wrong address, or fall for a scam, there's no 1-800 number to call. The responsibility is 100% on you. So, what's my recommendation? If you're a total beginner, starting with a highly reputable and regulated CeFi platform can be a good way to get your feet wet, but your long-term goal should be to graduate to DeFi. Learning to use a protocol like Aave is the purest form of this strategy. It eliminates that scary counterparty risk and gives you true sovereignty over your wealth. I've shown you a powerful way to get cash from your crypto, but I would be failing you if I didn't hammer home the risks. This is not a get-rich-quick scheme. It's a powerful tool that can blow up in your face if you're not careful. Let's be brutally honest about what can go wrong, starting with liquidation risk, which is risk number one by a long shot. The crypto market can have brutal sudden crashes. A 30% drop in a single day is not a wild fantasy. It's happened before. If you have a high LTV, a flash crash can liquidate your collateral before you even have time to open your laptop, so you must be ready for this. That means choosing a safe LTV and having a plan before the panic starts, including extra cash on the side to pay down the loan or add collateral if you get a margin call. Next is platform risk, the main CFI risk, where you are trusting a company with your money. The collapses of Celsius, BlockFi, and Voyager are recent painful reminders that even the most popular platforms can fail. They took user funds, made risky bets, and went insolvent, meaning your funds could be gone forever. Then there's smart contract risk, the DeFi version of platform risk, where you're trusting code. While major protocols like Aave and Compound are heavily audited and have managed billions for years, the risk of a hack is never zero. Be extremely wary of new, unaudited protocols promising crazy returns. That's usually where the danger is. And a new risk for 2025 and beyond is increased IRS scrutiny. Starting in 2025, brokers will be required to issue a new Form 1099-DA for digital asset transactions, making it easier than ever for the IRS to track your activity. Mismanaging this strategy could lead to unexpected tax bills and penalties. So, how do you handle these risks? Keep your LTV low. I'm going to say it until I'm blue in the face. A low LTV is your best defense, so set up alerts to notify you if your LTV starts creeping up. Don't put all your eggs in one basket. Consider spreading your loans across a couple of different, reputable platforms. Never borrow more than you can truly afford to lose, and be prepared for the absolute worst-case scenario. Once you've mastered the basics, you can start exploring more advanced plays that really mirror how the wealthy operate. The most powerful strategy comes down to one question. What do you do with the borrowed cash? If you borrow $15,000 for a vacation, that's fine. You accessed your wealth tax-free, which is a win, but you still have a loan you're paying interest on. The real galaxy brain move is to use those borrowed funds to buy another income-producing asset. You could use that $15,000 loan as a down payment on a rental property, where the rent you collect can be used to pay the interest on your crypto loan. Since the loan was used for an investment, that interest may be tax deductible, which can lower your overall tax bill. You're using a loan against asset A to buy asset B. Your crypto can keep appreciating, your real estate can appreciate and generate cash flow, and the whole system is incredibly tax efficient. Some people get even more aggressive with strategies like oil and gas drilling funds or complex cost segregation on rentals to create huge paper losses. But be warned, these are high-risk, expert-level strategies that can attract major IRS scrutiny. Similarly, while a charitable remainder trust can be a powerful tool for eliminating capital gains tax on a large sale, the deduction isn't a flat rate. It's a complex calculation based on your age, payout rate, and IRS tables, so you absolutely need a specialist to set it up correctly. By combining the borrow, don't sell mindset for your main crypto holdings with smart strategies for the borrowed cash, you build a true wealth-generating ecosystem. We've covered a ton of ground. We started with that frustrating feeling of being asset-rich, cash-poor, trapped by taxes and the fear of selling. Then, we unlocked the solution from the billionaire's playbook. Stop selling your best assets and start borrowing against them. This is how you get cash, defer taxes, and keep all of your future upside. We walked through building your foundation with DCA, managing your machine with a safe LTV, and we compared the worlds of CeFi and DeFi to help you get started. This is a profound mental shift. It's about turning your static investment into a dynamic source of capital. It's about taking control and making your wealth work for you. But please remember, this is a powerful tool, not a magic wand. The risks of volatility, platform failure, and getting wrecked are very real. Start small, keep your LTV low, do your own research, and never borrow more than you're prepared to lose. If you made it this far, you now have a blueprint that separates amateur speculators from sophisticated investors. You have a plan to finally break free from the golden handcuffs of crypto. Thanks for watching. If this video opened your eyes to a new way of thinking, hit that subscribe button. And for your next step, check out this video on the screen about the best crypto savings accounts to see another way to put your assets to work. I'll see you in the next one.